All right, well, welcome everybody to this webinar tonight. We're pleased to have our guest, Dmitry Fomenchenko. He is the founder and president of Sense Financial Services, a boutique financial firm specializing in self-directed retirement accounts with checkbook control. He began his career in financial planning and real estate investing in the year 2000, and he owns multiple investment properties in various states and is a licensed California real estate broker. Over the years, he has taught hundreds of investment and financial planning seminars and has mentored thousands of investors. So quite the extensive, background there. So we'll pass the time to Dmitry and let you go ahead and present with us.
All right, thank you, Don. Let me share my screen, make sure it's working. Can you see that?
Yep, we're good.
Okay, great. All right, so welcome everyone, and as Don explained, I'm gonna be talking today about using your IRA and 401k to invest in real estate. Just a little bit about myself. Don basically gave some background, but just to add that I'm not from here originally. I'm an immigrant. Immigrated in this country, which is the best in the world, by the way, back in 1996. Me and my family, we escaped from former Soviet Union. We came here as refugees and didn't have anything, and this country blessed me so much and blessed me. I learned about investments. I started a business. It's just been amazing. I know there's so many people complaining about where we're at now, but it's still the best country to live in. We are not CPAs. We don't provide investment or legal advice. I'm just going to share with you my expertise is in self-directed retirement accounts. So that's what I'm going to be sharing with you. Our mission as a company is to help our clients obtain control and protect their retirement accounts. I wanted to start by giving you an example. Basically, that's one of our clients. Jason is, he actually been with us for quite some time. One of our older clients. He had a couple of retirement accounts, an IRA and a 401k, valued about $135,000 combined. He was losing money in the stock market, and he was concerned about government because of the this unending borrowing of money by our government. He was concerned about government actually even tapping into private retirement accounts. There was a talk about that. So he was looking for solutions. He found us online, and he basically came in. We established a self-directed solo 401k plan for him. He purchased a rental property inside of his 401k, and then he invested portion of the funds into his brother's business. His brother is a serious entrepreneur. That was another venture of his. He was not able to do it with his conventional IRA, but he was able to invest in a private business with his self-directed 401k. And then the balance of the funds he actually used as a loan. So he lent to somebody else. So it basically was a real estate note. Combined at that time, those are actually older numbers. His cash flow probably doubled because of the rent increase over the years. But at that time, immediately he was receiving about $1,000 a month in cash flow. And he was owning assets that were not only producing income, but also appreciating in value. Again, that property probably at least doubled, if not tripled, since he purchased it. So as you can see, this is kind of a makeover, the before and after. Being in invested in a stock market, something that he could not control, losing money, and transitioning into something that is much more stable. He has much greater control. There is a higher income and much greater potential for the growth in the future. So today I'm going to explain three options for you. because those are the options when it comes to self-directed retirement accounts. There is a self-directed IRA with a custodian, there is a checkbook IRA, and there is a solo 401k, which is known as the ultimate retirement plan. So let's take a look at one at the time. But first, just a quick comparison of conventional retirement accounts versus self-directed. When you have a conventional IRA, many of you probably do have one of those accounts, either 401k with your employer or perhaps past employer, or 403b, 457, or an IRA. It is held by the custodian, and custodian controls the investment choices. Many people actually have this misunderstanding that you can't do anything other than the stock market because IRS doesn't allow that. There is nothing can be further from the truth. IRS doesn't approve any investments. IRS only has certain limitations, which I will explain. And there's really only two things that you cannot do or invest in with your retirement funds. But conventional retirement accounts are limited to stocks, bonds, and mutual funds. Here is an example of a sheet that I received when I was working for a company and I had a 401k. The representative from the 401k will come and meet with us about once a year, will give us a sheet similar to this one that will list the investment choices. And as you can see, about a dozen options, all confined to the stock market. Well, with the self-directed IRA or 401k, you have virtually limitless investment options. What you see here on the right side, just a few common investments: real estate, tax liens, cryptocurrency, mortgage notes, trust deeds, and on and on and on. I should add the campgrounds and parks to this list, because that's becoming more popular now. So what is a self-directed IRA? A self-directed IRA is a tax-deferred trust account that is held with the IRS-approved custodian, and it allows you to invest in non-traditional assets. Majority of people not even aware that they exist. If you talk to your financial advisor or a stockbroker, they might even say this is illegal. And the reason is either ignorance, or they simply don't want to let you go or let your money go because they make money off of your investments. But they've been around since 1974, and they designed to benefit people like you and I put away money for the retirement under Internal Revenue Section 408. So how does it work? Let's take a look at this diagram that I put together for you. Step number one is you open a new account with the IRS-approved custodian that, again, allows alternative investments. Step number two, you need to fund it. And because of the small annual contribution limit of only $6,000, most people fund it with the transfers from your existing retirement account, which again might be an IRA, Roth IRA, 401k, 403b. So you do this direct rollover of funds from your existing retirement account to the new account. There is no tax consequences, no penalties, completely tax-free. And from there, you, as the account owner, you direct the custodian what you want to do. You may want to invest in a piece of real estate. You may want to invest in a portion and become the passive investor in a fund, like Don offers, or again, like in example of my client, you may want to do a private loan and be a lender. Now, the advantage of this is that you have the ability to go beyond the stock market and invest in virtually anything. The two disadvantages to this model is that every time you make a transaction, custodian charge you a fee. So there is a fee for every transaction. There is a fee for each asset that you buy. And second disadvantage is that some people find this inconvenient because you don't have direct access to your IRA funds, you always have to go through the custodian. So custodian is essentially a middleman and act as such. So some people find this inconvenient. For this reason, they opt for a checkbook IRA. A checkbook IRA, also known as an IRA-owned LLC. Essentially, it's a special purpose LLC that is created for a single purpose to be owned by the IRA. So IRA is the single owner of this LLC. It does require a special IRS compliant setup and operating agreement, and it allows you to bypass the custodian when making investments and transactions. So let's take a look how it works. You also need a custodian that allows alternative investments. You move the funds the same manner, no tax consequences, no penalties from your existing retirement account. And that's where the difference is. A special purpose LLC is created. This is a single member LLC, which is has the only member is the IRA. Now, you're the manager. You're not the member, you're not the owner of this LLC, you're simply the manager of it. Your IRA owns it, but you control it. Once that is created, then we will instruct the custodian to buy LLC units. IRA buys 100% of the units of the LLC, and custodian issues the check payable to the LLC, which is deposited into the LLC checking account. LLC is a separate entity from you, separate entity from your IRA. It has its own unique name, and IRS issues a tax ID number or EIN to the LLC. And as a manager, you have the authority to go to the bank and open a checking account in the name of the LLC. That's where you deposit the funds from an IRA, and you control it from there. So as a manager, you decide that you want to buy a piece of property or invest in a note, and to make that happen, you don't have to go through middleman or custodian. You simply write the check or wire the money for the investment. When you receive investment income, you simply deposit that into the LLC checking account. So as I said, it allows you to bypass the custodian. Custodian is still there, but they're passive. And you control the IRA funds directly through an LLC. The advantage of this structure is that it eliminates the transaction fees and asset-based fees that custodian normally charge if you invest directly with the custodian. And it also eliminates the delays and all the red tape, because it does take the time for the custodian to process the request. And sometimes you can even lose the deal when you have to wait for the custodian. Here you can make the investment instantly, pretty much. And then the last option, which is certainly not least, is the solo 401k or self-directed solo 401k plan, which is known as the ultimate retirement plan. And the reason why it's called that, you'll see in the next few slides when I cover the advantages of this vehicle. But it's not a new plan. It's designed under Internal Revenue Code Section 401, and it's defined as a retirement savings trust. The solo 401k, what it implies, it's designed for self-employed individuals or small business owners that don't have any employees or full-time employees working for them. Essentially, it's a 401k plan that covers business owner or owners plus spouses if they're eligible, meaning if they also work in the business and receive compensation. The increased interest in these vehicles was after changes in the tax law in 2002, which made those benefits very attractive. So, but first let's talk about eligibility, because this plan is not for everyone. This plan is designed for those people who are self-employed. So you have to meet two criteria. Number one, you have to have a presence of legitimate self-employment activity. It can be in any way, shape, or form. Just some examples: you can be a consultant, you can be a real estate agent, you can be maybe a doctor that has your own practice. As long as you have either Schedule C income or own an entity such as LLC or a corporation, and you don't have full-time employees working for you, which is the second qualifier. You cannot have full-time employees working for you because the law requires that you offer retirement benefits to all eligible employees. So essentially, having a business with full-time employees is the only thing that could disqualify you from qualifying for a solo 401k. Because if you don't own a business, if you're not self-employed, there are ways to start that. And I actually have seen people do that. And there are reasons to do this. Number one, since we're talking about solo 401k, it will enable you to qualify for a solo 401k. But number two, I think most of you are on this call are investors, and you're looking for ways to reach financial independence or financial freedom sooner than later. So having that extra income by having maybe a side gig in addition to your job, perhaps. By the way, you don't have to be running a business full-time or be self-employed full-time. You can do this on the side in addition to your full-time job. I have many clients just like that. So let's take a look how it works. Number one, you have to have the sponsor of the 401k plan. And as I mentioned, it can be in any capacity. It can be a sole proprietor, a corporation, LLC partnership, and so on. As long as it's legitimate, then you will be eligible to adopt a solo 401k plan. So the sponsor of the plan adopts the plan, and plan and trusts are created. So 401k plan or solo 401k plan, or even self-directed solo 401k plan, utilizes a trust structure as the vehicle to hold assets of the plan. Now, custodian is required if you have an IRA. You must have a custodian, as we have seen in the previous slides, looking at the Checkbook IRA. You can bypass the custodian, have basically passive custodian, and do everything through an LLC, but custodian is required. In 401k structure, custodian is not required. So there is no need for a custodian, no need for a middleman at all. The trust is formed, and you are the trustee. And as a trustee, you control the assets of the plan. You control all the investments. You make all the investment decisions. So again, you're designated trustee. You're in control. As a trustee, you will be able to open a business checking account for a trust. A trust is a separate legal entity, has its own unique name, its own tax ID number, and you can open a bank account or a brokerage account at any financial institution for your 401k trust. And then as a trustee, you decide to purchase investment property or invest fund, your 401k funds into a fund, or do a private loan. All the income going back into the trust bank account, all the expenses are paid from that account. There is no middleman. It just costs you a nominal fee to maintain the structure, no transaction fees, no asset-based fees, no delays. And let's take a look at some of the other benefits. Number one, it's attractive to those people who are self-employed or business owners, because if you're self-employed or own a business, you have much higher ability or potential to making more income. Having or working as a job, there is a limit, there is a ceiling how much you can make, because job is not designed to make you wealthy. It's designed to make the business owner wealthy. But as a self-employed individual or business owner, you have much higher ability to make more income. Well, with more income comes more taxes. And that's a common challenge that I talk to people that sharing this concern with me. Well, guess what? If you are self-employed and open a solo 401k, you potentially can shelter up to over $60,000 of your income from taxes by contributing that into your solo 401k plan. And guess what? If you're and your spouse in the business together, you potentially can double that. I mean, just think about the effect that this may have on your bottom line. I mean, if you're in business together with your spouse, then together you can shelter over $120,000 of your combined income from taxes into your retirement account. I mean, $120,000, that's a lot of money. Think about how much taxes you're going to save on that. Immediately, that's going to drop you probably in a lower tax bracket, or maybe two, right? So you're going to be in a lower tax bracket, paying on significantly lower amount. So it's not uncommon for people to save $30,000, $40,000, $50,000 just in a year if you're able to maximize your contributions with your spouse. I've seen that. So that's one of the top benefits. Also, solo 401k comes with the loan feature, just like a 401k you may have at work has a loan feature. The same feature allowing you to borrow from your 401k up to $50,000 or 50% of the balance, whichever is less, can be used for any purpose. So it's a nice, it's kind of I guess, a HELOC or a line of credit that you have against your own 401k. Though it's there available. You are with the solo 401k because you're the administrator of the plan. You'll be the one applying. You'll be the one approving the loan. So again, potentially, if you're a husband and wife team, you potentially can tap into $100,000 of your retirement funds early. Now, you're going to have to pay it back, of course. It's a loan, but you don't want to abuse that, but it is a nice feature to have. Next, Roth type contribution. A solo 401k has a Roth provision allowing you to make Roth contributions. Now, compare that with a Roth IRA, which has the limit of $7,000. With the Roth 401k, you can contribute up to $27,000 potentially. And that's not dependent on your income, because Roth IRA is income dependent. If you're over certain income threshold, you're not eligible to contribute, which you can always do backdoor Roth IRA and still get those funds into Roth, but still the limit is significantly higher compared to an IRA and Roth contribution. And this 27, by the way, is part of the 67, part of the total limit. It's not additional. Now, because there is no custodian and there is no middleman, you control the account. You have the checkbook control. You literally will have a checking account for your 401k. So it's gives you checkbook control. It's very cost effective because you don't need to go through a middleman. And there is just a nominal fee to maintain that. Very cost effective. No custodian, you control as a trustee, and you potentially can double the benefits if your spouse is also eligible. And then it is exempt from unrelated debt finance income, which is income that is derived from a leveraged real estate. If you use an IRA to buy real estate and use leverage, there will be some tax consequences. 401k is exempt from that specifically. Well, the bottom line, it allows you to have a true diversification. This cartoon, the credit for that goes to my daughter. She's been, when she was little, she loved doing things like that. And she has love for other things now. She does much better work now, but the husband holds a basket and the bottom fell off and all the eggs are gone, they're broken. And the wife says, well, I thought our investments were diversified. Well, guess what? If they are all in a single basket, they're not diversified. Some people think, well, I'm investing in mutual funds. I have diversification. And yes, you do have some diversification, but it's within the same asset class. It's still stock market. You just have many different pieces broken into many different companies, but it's still stock market. To achieve a true diversification, you have to have a self-directed account. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. We don't know what's going to happen tomorrow. I mean, you don't have to go back far. Look at beginning of this year, right? What happened with the market? People still telling me that they lost 20-30% of their balances in their IRAs or stock portfolios. How about a couple of years ago when the pandemic hit? Another significant drop, and it might take a long time to recover. But you do have options, other options. Invest into something that has less risk, gives you more control, and has the potential for higher growth. Self-directed means unlimited investment choices. Again, those are just a few common ones. It's pretty much up to your imagination what you want to invest in. But let's talk about those limitations. As I mentioned earlier, IRS does not approve any investments. So when you hear somebody says, "Oh, this is an IRS approved investment," you gotta run away from that, because IRS doesn't approve any investments. What IRS does is they, in this Internal Revenue Code section 4975, they describe prohibited transaction rules when it comes to retirement accounts. And they say that you cannot invest in any collectibles, and collectibles can be collectible stamps, collectible coins, collectible artwork, anything that is considered collectible. It's a no-no for your retirement account to invest in. You cannot invest in S corporation because S corporation shareholders can be only individuals. So a retirement account cannot be part of the S corporation. Now, if you own a business and your business is structured as an S corporation, you certainly, and you have no employees, you certainly can establish solo 401k plan or self-directed IRA, but you cannot invest into another S corporation. Just want to make that very clear. And then you cannot invest in life insurance with your IRA. So that's another limitation. In addition to that, the IRS rules dictate that your retirement account cannot get engaged in any transaction with disqualified person. So who's a disqualified person? It's basically yourself, your spouse, your parents, grandparents, your kids, grandkids, and their spouses. So it's immediate family members. And think of it vertical line, okay? Vertical line, parents and children, grandchildren, grandparents, right? Vertical line. You can actually go sideways. Your brother, your cousin, your uncle, those are not considered disqualified persons. So you can potentially go sideways, just not vertical line. So let's take a look what those prohibited transactions are. And as you can see, they pretty much all have disqualified person involved. So, it's a sell, exchange, or leasing of a property between a plan and disqualified person. Well, an example of that can be you buying a rental property inside of your IRA or 401k, and you bought it in a town where your child goes to college. Well, guess what? You cannot lease that property or a room to your child. Your child cannot stay in that because that will be a transaction between disqualified person and the plan. That is prohibited. Another one, lending of money or other extension of credit between a plan and disqualified person. Well, example of that can be, again, buying a rental property in your self-directed solo 401k plan and financing that property. You can finance You just cannot guarantee that loan. That's why you cannot use conventional financing. The loan has to be non-recourse. And non-recourse means that there is no personal guarantee. There are lenders that specialize in this. We have a list of them on our website. Certainly possible. Next, providing goods, services, or facilities between a plan and a disqualified person. Well, example of that can be, again, buying that rental property and you actually a real estate agent. So you as a realtor, you're self-employed, you establish solo 401k plan, you funded that with 60 grand contribution. Now you want to put that as a down payment, buy a rental property. Well, guess what? You cannot be the agent on that transaction because you're not allowed to provide services to the plan. So that will be a prohibited transaction. You have to use another agent who's not related to you. Next, transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. Example of that can be you bought a vacation rental in a popular vacation destination and you renting that on Airbnb or elsewhere. Well, you personally cannot come and use that property, even regardless whether you pay in market rent or not. You're again, any of those disqualified persons on the list, vertical line, cannot use that property. That's prohibited. And by the way, the previous point, providing goods or services, also example, I think I should mention is you cannot do any work on the property yourself. So if you're a handyman and property needs a fix up, you can't do any work because that will be considered providing services. That will be disallowed. And then next, act by a disqualified person who's a fiduciary, which is yourself, maybe your spouse, where he or she deals with the income or assets of the plan in his own interest. So all the income belongs to the 401k and for the benefits of the 401k only. And receiving any consideration for your own personal account by any disqualified person who's a fiduciary from any party dealing with the plan in connection with the transaction involving the income or assets of the plan. The bottom line, prohibited transactions are pretty easy to spot because they normally involve disqualified persons. So you want to make sure the transaction is arm's length. Arm's length meaning that there is no involvement of a disqualified person. Buying real estate, whether it's physical real estate or you buying into a fund or something else possible, but this applies to actual physical real estate because it's very common. People do buy rentals. It's pretty straightforward. All the income and gains generated by the account are tax deferred. So you're going to be paying taxes at a future rate, which enables you to actually take advantage of the compounding because your account is not depleted by paying taxes on the gains or income. So it can grow faster. If you're using Roth, 401k or an IRA, it's going to be tax-free at the end, and all the income must go back to the account and all the expenses must be paid from the account. As I mentioned, you can finance. You just cannot use a conventional financing because personal guarantee is prohibited. Loan must be non-recourse, which means that property is the only security for the loan. Typically, non-recourse lenders will want 30 to 50% down. So it is a higher down payment because the risk to the lender is higher. But 30% down is better than paying 100% for the property. So your ROI is still going to be much higher. Still makes sense. Property must have sufficient cash flow so that there is enough income to pay the mortgage payments and other expenses. Lender will require reserves, typically 10% of the purchase price. It will trigger UDFI tax for an IRA. 401k is exempt from that. And there's only a few banks and lenders that offer that. So here is a side-by-side comparison of the three so that you can kind of look at it, see for yourself. You can invest in non-traditional assets with either vehicle. You do need a custodian for an IRA. There is no custodian with solo 401k. You don't need one. Now, some custodians do offer self-directed solo 401ks, but remember, you're not required to have one. So if you want to have ultimate solo 401k, then you don't want to use custodian for it. You can have the checkbook control with the IRA LLC structure or with the solo 401k. Now, the IRA LLC structure comes with the LLC fees. Some states don't charge fees for the LLCs, some do. So it's dependent on the state of LLC formation. You can take a personal loan only from a 401k. There is no such option with an IRA. You cannot borrow from an IRA. The contribution limit, as you can see with the solo 401k, is nearly 10 times higher compared to an IRA. And you can have built-in Roth IRA within solo 401k only. And also, it's not for everyone. It requires legitimate self-employment activity or business. Well, wow, that was a lot of info. I'm catching my breath. I think we have a couple of questions that we might be able to address this, but I would like to offer all of you who are on this call to the opportunity to have a chat with me one-on-one, and you can do so just by going to our website to this URL directly, or actually on the homepage, you will find a link to my calendar, and you can schedule a complimentary 15-minute consultation where we can talk about your specifics, because everyone's situation is different. There is no two situations that are the same. Everyone's situation is different. I'm happy to chat with you specifically about your particular circumstances, and maybe give you some feedback, share with you. I'm practicing what I'm preaching, so I'm investing with my self-directed account as well for 10 years almost. It's been great. Manage both mine and my wife's, and so certainly can help you from that perspective. This is my contact information. I'm going to turn it back to Don for questions.
Yeah. All right. Well, thank you, Dimitri. That was very informative, and like you said, the whole lot of information. So, just so everybody's aware, we will be sending out a replay of this webinar, so you can go back and watch it again later, kind of go through it all, because there's a lot in there. One quick question, Dimitri, somebody asked at the beginning is, and I didn't ask you this ahead of time, I guess, are you able to provide the slides that you shared today, that we can let those that are here have those as well, or no?
Sure, yeah, I can definitely share. I think Dan might have your email, so we can certainly send that out. But also, I believe, Dan, this is being recorded. So,
yes.
And Dan is going to be sharing the recording. So I personally find that I need to review information or watch things twice just before I fully comprehend certain subjects. So that might be worth watching again to catch on certain subjects. So either way, yes, you can get a copy.
Okay, great. Okay, first question here in the chat. Of course, we'll go through the ones in the chat first, and then we'll let you unmute yourselves and ask anything additional if needed. So the question here says, can you start a solo 401k and then roll other tax deferred monies like a traditional or Roth IRAs into the solo 401k to increase its balance beyond what you've directly contributed into the solo 401k from the self-employment income?
Yes, you certainly can, and you can, and that's, I think I was explaining that on the slide, that it can be funded with the rollover. So certainly, yes, you can make large contributions, but there is two ways to fund the retirement account, whether it's an IRA or 401k. And one is a contribution. Obviously, solo 401k has a significantly higher limit compared to an IRA, but not everyone in the position to contribute. You might have that old 401k with a couple of $100,000 that you want to get out from the stock market, you can move that into a self-directed IRA or solo 401k. Solo 401k will accept rollovers from any qualified retirement plan with one exception, and that is a Roth IRA. So I think you mentioned here, Peter, in your question, Roth IRA. So Roth IRA cannot be rolled over into a solo 401k because IRS doesn't allow that. They don't allow Roth IRA to go into 401k, only to another Roth IRA. So you can self-direct Roth IRA, but it cannot go into solo 401k. But all the other accounts can, including Roth 401k. So if you have a Roth 401k from the past employer, that can be rolled over into Roth solo 401k, just again, specifically not Roth IRA.
And obviously, Peter, if you need more something in depth on that, you can ask more, or obviously contact Dimitri after. So I also asked that, so you mentioned in the solo 401k that it is exempt from the UDFI. Is it also exempt from the UBIT or UBTI? We don't know if those are only for IRAs only, or if that's also with the 401k. Can you explain
Okay,
that?
well, let me explain what those terms are. UDFI stands for unrelated debt finance income. And that income happens in tax-exempt entities, which is IRAs and 401ks are. So if you finance a property in an IRA, so let's say you're buying a property for $200,000, you put $100,000 down, and you obtain the loan for $100,000. Half of the income that you receive from that investment is received from a leveraged portion of the property. You used bank's money to buy that portion of the property. So technically, half of the income will be subject to UBIT. And UBIT stands for unrelated business income tax. So that UDFI income in an IRA is subject to UBIT, unrelated business income tax. Now, you can deduct half of the expenses, half of the mortgage payments, property taxes, insurance, and the depreciation too. But there is going to be a portion of the income that is subject to UBIT tax. Now, in a 401k, if you finance the property, then no income will be subject to UBIT tax. All the income will be tax exempt. Okay. Now, but that doesn't mean that UBIT doesn't apply, period, to the 401k. Because if you have business income in your 401k, and business income, an example of that can be it's not a common example. People normally don't do that for this reason. But let's say you wanted to buy a franchise in your 401k. So you bought a franchise, whether it's a car repair shop or a restaurant. Well, it's a business. A business generates business income. A business income is subject to unrelated business income tax in all qualified retirement plan and all nonprofits. Frankly, if there is a nonprofit on down the street, such as a church, for example, if church engages in a business activity, that business income will be taxable for that particular organization. So it will be for an IRA and 401k as well. So solo 401k is not exempt from UBIT, period. It's exempt from UBIT unleveraged real estate specifically.
Thanks for that clarification. I've got a few questions until somebody else comes up with something. But first of all, you said at the beginning that the cost to set up the solo 401k is nominal or minimal, I guess. Can you share approximately what that be, or is that going to depend on the situation and what's all involved?
No, it's a flat fee. We charge $600 to set that up, which covers creation of the qualified plan, all the legal documents. It includes the IRS adoption agreement. It includes the IRS determination letter and all the trust documents. And it includes support for the first year. And then starting in year 2, the cost to maintain it's flat $200. So that pays for all the required IRS amendments, restatements as required by the IRS, sponsor reporting, and also unlimited support from our team. So it's very nominal. Again, there is no, it's fixed, and it's regardless if you have $20,000 in your 401k or $2 million, the cost is the same.
That sounds like this is a great deal to me. Okay, we've got a hand raised here, a question from Serena.
Yes.
Go ahead.
Hi, good evening, everyone. Thank you so much for, giving us your knowledge and offering us this opportunity. I have a question. If I have a full-time job and I'm contributing in that 401k, can I additionally have this 401k to the side and be invested in it and doing the purchases of real estate?
Well, it depends. So you have a full-time job and you have a 401k there and you maximize contributions there.
Mm-hmm.
The question is, can you also take advantage of the 401k? I'm assuming you watched the whole video or whole presentation and you understand the criteria. So you need to be self-employed or own a business in order to establish solo 401k. Are you eligible?
Okay, so in my situation right now, I have my own LLC because I'm a business contractor. But I'm planning to do a full-time in the future for certain purposes. So I wanted to know if, having my LLC, my whole consultant, and also having a full-time, if I could do it. So that was.
So what you're saying is you have a full-time job, but then on the side you have a business, consulting business, correct?
Yeah, that will be the scenario in the future. Right now, I have my own consulting business, but I'm planning to do full-time just for a period of time for certain purposes.
Okay. Well, as long as you maintain your consulting business, because you have to maintain that eligibility.
Okay.
As long as you maintain the consulting business on the side, you can, as I mentioned, you can have full-time job and just do something on the side. As long as you maintain that, then you are eligible for solo 401k. You can establish solo 401k. You can fund it now with the income from your self-employment income. In the future, if you get a job and you maximize a 401k there, you can still maintain the 401k and you can continue to contribute. Now, I didn't have time here in this presentation to explain the details for the contributions. As I said, it's nearly 60,000 you can contribute. And there are two components for contributions, which is you contribute as an employee of your business, and then the business contributes profit sharing contribution. So the employee component, there is a limit, there is a cap on all the plans. So if you're maximizing your 401k contributions at work, which is for this year, it's $20,500, and actually next year the limit was raised $2,000. But if you're doing that, then you won't be able to put any more as an employee in your solo 401k.
Okay.
But you can still do profit sharing contribution, because profit sharing contributions in the solo 401k is completely unrelated to your employer 401k. So you can still make profit sharing contributions in the solo 401k.
Okay, thank you.
You're welcome. Thanks for the question. A good one.
It's a good one. All right, Kenton's asking, and I'm not sure if I understand the question here, so you may have to unmute yourself and ask if I don't get it right here, but he wants to know about if funding after-tax net profits in a Roth type checkbook account, so that growth would not be taxable. Is that possible, and what are the annual limits?
Well, the question is, where is the money coming from? So if you have existing Roth IRA or a Roth 401k, you can convert that to a self-directed IRA or 401k and invest tax-free. You can use the checkbook control with the IRA, and if it's a Roth IRA cannot go into solo 401k, so it has to be checkbook Roth IRA. And yeah, you can grow that tax-free potentially. If you have pre-tax money in a pre-tax accounts, traditional IRA or just a 401k from the former employer, you can also move those funds and then you can do a Roth conversion. So you can convert it to Roth, which will be a taxable event, and then you can invest tax-free from that point on. So it's certainly possible. There is a limit on contributions. So that's your second part on the limits. There is a limit on the contributions, how much you can contribute, but there is no limit on the conversion. So if you have $1 million that you want to convert from a traditional IRA to a Roth, you can. There is no limits for that.
Well, the point is I don't have any retirement accounts. So I'm earning money and I want to take that money, pay the tax on it, put it in a Roth type account. And then from that point, double, triple, quadruple that. So in other words, I'll take the hit early as long as I can get it tax-free after that.
Oh, I see. Well, then, you earning money from a business or from passive investments?
From a business, net profits.
Okay, so as you've seen in the slide, you can contribute $67,000 to 401k potentially. You can potentially put up to $67,000 into Roth 401k this year, and so there is a limit, $67,000.
Oh, I thought that had to be earned income. Okay.
Well, yes. It is based on the earned income, but that's a contribution limit based on the earned income.
Okay. Well, earned income to me means that you got it from an employer, a W-2 or something like that.
No, not the employer. Profits. It has to be earned business income or self-employment income.
Okay, good. So there's a good way to do it. It says 67,000 or double that if it's a spouse, and then put that into a Roth type account, and then go reinvest it and do all kinds and grow it to tenfold if you can, right?
Yeah. So
tax free.
Ken, this is really good question. That's a really good example of actually to discuss one-on-one, because we can't really cover this here. So yes, you can, but the details how to do that I can spell out for you one-on-one. But it's certainly possible.
Make sure you don't step in any IRS potholes along the way, right?
Yeah, and the reason really for that is I'm not always eager to answer questions that I don't fully understand. What I like to do always, I like to make sure I fully understand the question, okay? Because I don't want to provide answer that is only partially correct or partially incorrect. That's why, and I always try to put myself into your shoes. So that's why I ask, a lot of questions so I can fully understand what the situation is. And then, I can kind of place myself there and what would I do? So then I can kind of present that perspective to you, and then you decide how you want to handle it.
Well, that's very integrous of you, because some people just throw out these answers and then you go off half-cocked, like I did about the earned income on a Roth IRA. So that's very good. And the reason I asked this publicly, as I knew it wouldn't be easy, is because a whole lot of people in here, obviously, that Don knows are attracted to the real estate industry. And so therefore, you're already going to be producing net profits from your real estate, right?
Yep.
Yeah. So what do you do with those? I'd rather take one hit and then be able to take that back out and go make a whole bunch of money on real estate investments.
Yeah. Yeah, that's true.
Thanks, Ken.
Very good.
All right, we got Walter's got a hand up. Walter, if you want to go ahead and unmute yourself and ask your question.
Hey, Dimitri. Thanks for sharing the presentation, your knowledge of the 401k. So my situation is I'm a full-time employee, have a fully sponsored 401k through Fidelity. Now, our plan rules are that we can do some type of loans, personal loans, and purchases for homes and some of that stuff. But within our 401k, we cannot invest our 401k into money, real estate, gold, crypto, anything other than what we have in there. Now I do self-manage it, which what they call broker link. So I do self-manage all my stocks within the 401k, which we're allowed to do. Is there a way for me to fund a the self-directed 401k while I'm still working? I am a real estate agent on the side, do produce income on the side, have an LLC. So I already do those things. I just wanted to find out if it's possible to use that money to while I'm working full time, and I expect to be doing that for the next 2 years, to actually take that money and fund the self-directed, one of the self-directed options you talked about. Thanks.
Yeah, that's another good example of kind of spending some time one-on-one, but I'm going to try to compress my answer. So as a real estate agent, you are eligible for solo 401k, so that's going to be an instant win for you. As far as accessing funds from your existing 401k at work, usually you cannot access those funds while you're employed there and until you either reach a retirement age or no longer employed. Now, there might be exceptions depending on how long you've been there. Maybe the portion of the balance is vested, so you might be able to tap into a portion. It's a question that I cannot answer. You got to contact your plan administrator and ask them this simple question: can I do in-service distribution? Just this very brief question, in-service distribution, which means that in-service means that you're still employed. So while you're still employed, can you move the money out? And see what they say. If they say no, then you're out of luck and you won't be able to access those funds until, and again, they'll tell you when you will be eligible, but I don't want to give you high hopes. Typically, if you're employed, you won't be able to access those funds. But it's worth contacting them directly and asking.
Yeah, thanks for the answer. Yeah,
Sure.
I was pretty sure that's what it would be. But yeah. Okay, well, thank you for the answer. I appreciate your time.
Sure.
Hey, is it any more maybe one last question? We're definitely going to be cognizant of everyone's time. And if not, that if they want to at least thank Dimitri for sharing this knowledge and wisdom with us, and everyone who could come here tonight to participate with this. Obviously, if you have additional questions, feel free to reach out to Dimitri and contact him directly and set up get that time scheduled to talk about your unique specific situation and what works best for you. I do want to at least give one more plug here tonight. Tomorrow night with Happy Camper Capital, we do have another webinar coming up where we are talking about one of the campground properties which we purchase and invest in, which if you had one of these accounts set up, it sounds like you could take those funds and invest it with us as well. So I'm going to put the registration for that in the chat just in case you'd like to come to that and participate to hear kind of what we're doing and see the kinds of returns you could get, especially inside of a tax deferred account. So again, thank you, Dimitri, for your time and for being here with us today. And yeah, thanks everyone for coming.
Could you post that registration link?
Yes, I just put it in the chat just now.
Oh, you just did? Okay. Yep. Oh, I keep doing that.
All right.
I did that yesterday, 2 days ago. Okay. All right. Thanks.
All right. No problem.
Gotcha.
All right. Thanks, everybody. Have a good night.
Thank you, Dan.
Thanks, Dimitri.
Thank you very much, Dimitri.
You're welcome.
Thank you. Bye-bye.